Welcome back. This is Dan, and let's make millions. In today's video, we're going to look at 12 stocks that are a great buy today. These stocks all have a great history and offer balanced diversification. So without further ado, let's get into it. Number 1, Clorox, ticker CLX, currently has a dividend yield of 2.34%. Clorox was identified early as one of the best stocks to benefit from a virus pandemic. Clorox sells bleach, disinfectant wipes, and other assorted cleaning products. And as frequent cleaning is the first line of defense against COVID-19, the company will probably report record sales when it announces its quarterly results. But throughout this crisis, we really are cleaning more. The bleach, wipes, and other cleaning products are getting used up as we go. Furthermore, that's likely to continue for months and possibly years once the crisis passes. CLX is a quality blue chip stock that is likely to see above average sales and earnings for at least the next several quarters. Number 2, Enterprise Products Partners, ticker EPD, currently has a dividend yield of 11.65%. Energy stocks have been hit very hard by this pandemic, and there's no immediate reason to believe that will change. But still, a few energy stocks are cheap enough today to warrant buying. One example is EPD, considered one of the best blue chip stocks in the midstream pipeline space. Enterprise has almost no exposure to crude oil prices, as its business consists primarily of transporting and storing natural gas and natural gas liquids. Nonetheless, EPD shares are now roughly 50% below their 52-week highs and trade at prices first seen in 2006. We can't know for sure when conditions will improve in the energy sector, but EPD, with a monstrous payout that's still well supported by current cash flows, might be one of the best high-yield stocks to buy during the dip. Number 3, McDonald's, ticker MCD, is currently yielding 2.85%. Like most restaurants, McDonald's has had to adapt during the coronavirus scare by closing most of its dining rooms, but the company has managed to keep its drive-thru windows open in most locations and offer delivery through apps such as DoorDash and Uber Eats. We won't know how sales have fared until the company reports its quarterly earnings in April, but early indications are that they should be relatively strong. McDonald's is a rock, and it has adapted itself over the decades, and you can bet the company will adapt and come out of the coronavirus crisis stronger than ever. Number 4, Alibaba Group, ticker symbol BABA, is my only stock pick that has no dividend. Consider Alibaba Group one of China's largest and most dominant tech companies. It's one of the few Chinese internet firms that can credibly compete with the American giants globally. It's something of a hybrid between Amazon and eBay, though it also has elements of Google and even PayPal. China's economy will probably enter technical recession this year for the first time in decades, yet Alibaba's stock price is down less than 15% from its all-time highs. The Chinese export monster might never fully recover from the coronavirus recession, particularly if companies react to the supply chain distributions by bringing production closer to home. But China was already busily transitioning to a more domestically oriented consumer economy, and Alibaba is a big part of that. Alibaba also is well equipped to survive any downturn with 3 times as much cash as debt. Number 5, CocaCola. Yes, again, ticker symbol KO is on this channel, with a dividend yield of 3.5%. The loss of restaurant orders will take a bite out of Coca-Cola's revenues, but early indications are that increased home purchases of soft drinks, bottled water, and energy drinks should be largely offsetting restaurant losses. We'll find out soon enough when Coca-Cola issues its quarterly results in May, but it should be safe to assume that a consumer staple stock like Coca-Cola will get through this crisis with relatively minor scratches. Number 6, AT&T, ticker symbol T, has a dividend yield of 6.91%. AT&T is featured on Simply Safe Dividend's Best High Dividend Stocks list, and has paid a higher dividend for 34 consecutive years. But the company has undergone some rather dramatic business changes in recent years. From acquiring DirecTV to merging with Time Warner, AT&T has morphed into a true media conglomerate. While AT&T's pace of dividend growth will remain very moderate during this period, the stock's high yield provides income investors with some nice compensation as the business digests its recent deals and works on evolving for the future. Number 7. You'll have seen this stock in some of my other videos. Enbridge, ticker symbol ENB, has a dividend yield currently of 8.5%. Enbridge offers a rare combination of yield and growth, at least for the next few years. Enbridge owns a network of transportation and storage assets connecting some of North America's most important oil and gas producing regions. As the continent's energy production grows over the years ahead, thanks largely to advances in low-cost shale drilling, demand should also increase for many of Enbridge's pipeline-focused capabilities. Number 8. Southern Company, ticker symbol SO, has a dividend yield of 4.5%. Southern Company has an amazing track record of paying uninterrupted dividends since 1948. The utility serves 9 million electric and gas customers, primarily across the Southeast and Illinois. In May of 2018, Southern announced it would sell off 2 of its smaller utility subsidiaries for approximately $6.5 billion in order to strengthen its balance sheet and solidify its investment-grade credit rating. By focusing on its core utility operations, management expects to project stronger earnings growth. When combined with the company's payout ratio near 80%, which is reasonable for a regulated utility, Southern is positioned to continue rewarding shareholders with generous, moderately growing dividends. Number 9. National Retail Properties, ticker symbol NNN, has a dividend yield of 6.8%. National Retail Properties has increased its dividend for 29 consecutive years. For perspective, only 2 other publicly traded REITs in America have equal or longer dividend growth streak. This REIT owns approximately 2,800 freestanding properties that are leased out to more than 400 retail tenants. As a triple net lease REIT, National Retail benefits from long-term leases with initial terms as long as 20 years. The firm's portfolio has not seen its occupancy dip below 96% since 2003, which is a testament to management's focus on quality real estate locations. Number 10. Exxon Mobil, ticker symbol XOM, has a dividend yield of 8.44%. Exxon Mobil has one of the most impressive dividend histories of any American company. They have not only paid an uninterrupted dividend for more than 100 years, but the firm also has raised its payout every year since 1983. Despite the volatile nature of the energy sector, Exxon's disciplined capital allocation, conservative use of debt, and focus on complementary business units have made the stock a very reliable source of income over the years. Exxon plans to spend around $200 billion between 2018 and 2025 to significantly increase its upstream production and chemical production, while improving returns on invested capital across each of its business segments. Number 11. Universal Corporation, ticker symbol UVV, has a dividend yield of 6.76%. Universal Corporation boasts an impressive track record of paying increasing dividends without interruption for 47 consecutive years. The company has focused on supplying tobacco leaves to manufacturers of tobacco products since its founding in 1918. Tobacco products manufacturers have little choice but to work with Universal, providing a steady flow of demand. Little capital is required to maintain Universal's core business as well, resulting in very consistent free cash flow generation. Combined with Universal's investment-grade credit rating and reasonable payout ratio, the company should have no trouble continuing its impressive dividend streak. In fact, management boosted Universal's dividend by 36% earlier this year in a sign of the team's confidence. Number 12. Universal Health Realty Income Trust, ticker symbol UHT, has a modest dividend yield of 2.73%. UHT is a healthcare REIT with 69 investments in a variety of hospitals, emergency departments, medical office buildings, and child care centers across 20 states. The firm has increased its dividend each year since its founding in 1986. Medical office buildings and clinics account for 74% of the firm's properties, which are less dependent on federal and state healthcare programs, which reduce risk. As management continues focusing on high-quality areas of healthcare that will benefit from America's aging population, the stock's dividends should remain safe and growing. While I hope this list has given you some options to consider, all of these companies have different strengths and weaknesses, but are solid at their core. Some will ascend quickly, while others may be slow. Take some time and assess which may fill voids in your portfolio. For more videos, please like, comment, and subscribe. As always, thanks for watching. This has been Dan, and stay smart.